If you've been looking for a simple way to build long-term wealth without needing to be glued to a computer screen all day, dividend investing might be the strategy you've been searching for. And in today's video, we're breaking down exactly how to start dividend investing for beginners in 2026. Whether you're starting with $100, $1,000, or even more, this guide will help you understand what dividend investing is, how it works, why it can be so powerful, and the steps you should follow to build your own dividend portfolio the smart way. Welcome back to Stock Predictor, and if you're watching this because you're ready to take real steps toward financial independence, you're in the right place. So, let's start with the simplest question: what exactly is dividend investing? Dividend investing is when you buy shares of companies that pay you a portion of their profits, called dividends, usually every quarter. Think of it like this: you become a part owner in the company, and in return, the company pays you a small piece of its earnings just for holding the stock. You're not actively doing anything. You're not trading daily. You're not monitoring charts. You're simply collecting income while the company does all the work. Now, in 2026, dividend investing is more popular than ever because the economic landscape has changed. Inflation has remained sticky, interest rates are stabilizing, and investors are looking for reliable, sustainable income. Dividend stocks offer exactly that: steady cash flow and long-term growth. And the best part is that you can start small. That's what makes this such a beginner-friendly strategy. But here's the catch: not every dividend stock is a good investment. Some companies pay high dividends because they're struggling. Others pay low dividends but have rock-solid fundamentals. So the real key to getting started is knowing how to identify the right companies and how to build a diversified dividend portfolio that grows your income year after year. Let's break down the process step by step so you can start building your own dividend-paying machine. The first thing you need to understand is your investment goal. Are you investing for long-term passive income? Are you trying to replace your job's salary one day? Are you reinvesting dividends to grow your wealth faster? For most beginners, the best strategy is dividend growth investing, buying companies that not only pay dividends but increase them every year. These increases help your income keep up with inflation and can dramatically boost your returns over time. Now that you know your goal, the next step is choosing your brokerage. In 2026, the most popular beginner-friendly platforms remain Robinhood, Fidelity, Schwab, M1 Finance, and eToro. You want a platform that offers zero commission trading, easy dividend reinvestment, and low or no account fees. Most of these platforms allow fractional shares, which means you can buy even a small portion of a high-priced stock. This makes it much easier to start, even with a small amount of money. After you set up your brokerage, the next step is understanding dividend yield. Dividend yield is the percentage of your investment that a company pays back to you each year through dividends. For example, if a stock costs $100 and pays $4 in dividends annually, its yield is 4%. But here's what beginners often get wrong: higher yield does not always mean better. A super high dividend, like 8% or 10%, can sometimes be a warning sign that the company is in trouble. The stock price may have dropped, or the dividend might not be sustainable. As a beginner, the sweet spot is usually between 2% and 5% from companies with strong financials and consistent earnings. Next, you'll want to learn about payout ratio. The payout ratio tells you how much of the company's earnings are being paid out as dividends. A payout ratio under 60% is usually considered healthy, depending on the industry. If a company is paying out almost all of its earnings just to keep its dividend alive, that dividend is at high risk of being cut. And the last thing you want as a dividend investor is a dividend cut. Another important factor is dividend growth. Companies that increase their dividends year after year are known as dividend growers. Some of the most famous are dividend aristocrats, which are companies that have increased their dividends for at least 25 straight years. These companies are usually stable, profitable, and have strong business models that survive recessions and changing economic cycles. Examples include Johnson & Johnson, Procter & Gamble, Coca-Cola, and PepsiCo. These companies won't give you the highest yields, but they offer reliability, stability, and long-term compounding power. Now, let's talk about diversification. As a beginner, you don't want to put all your money into just one or two stocks. A good dividend portfolio spreads your investments across different sectors. You might include consumer staples, utilities, energy companies, real estate investment trusts, REITs, financials, and technology. Why? Because when one sector struggles, another might perform better. Diversification protects your portfolio and helps you maintain steady income through all types of market conditions. So what are some popular dividend-paying sectors to explore in 2026? Consumer staples are companies that sell everyday items like food, beverages, and household products. They tend to perform well even during recessions because people still need essentials. Utilities are another great choice. These companies provide electricity, water, and natural gas. They often offer steady dividends because they operate in regulated industries with predictable revenue. Real estate investment trusts, or rights, are also major players in the dividend world. They are required by law to pay out at least 90% of their income as dividends. Some rights invest in apartments, some in commercial buildings, some in warehouses, and some in data centers. They offer diversification that you won't get from normal stocks. But what if you don't want to pick individual stocks? That's where dividend ETFs come in. ETFs like SCHD, VYM, HDV, and DGRO hold dozens or even hundreds of dividend-paying companies in one fund. This gives you instant diversification, low fees, and reliable income. Many beginners start with an ETF-based dividend portfolio because it saves time, reduces risk, and still provides solid returns. Now, let's talk about one of the most powerful elements of dividend investing, dividend reinvestment. When you reinvest your dividends, you're buying more shares automatically. Those new shares earn dividends too. Then those dividends buy even more shares. This creates a snowball effect known as compounding. Over the years, this snowball grows faster than you think. A small portfolio can become a large income machine if you stay consistent and reinvest for long enough. Here's what many new investors don't realize. The earlier you start, the more powerful compounding becomes. Even investing $50 or $100 per month can have a dramatic effect after 10, 15, or 20 years. Your future income is determined by the habits you build today, not the amount, but the consistency. Another key point. Dividend investing is not about timing the market. It's about time in the market. The longer you stay invested, the more dividends you will collect, the more shares you will accumulate, and the more your income will grow. Even when the market goes down, long-term dividend investors keep buying because lower prices mean higher yields and more shares for the same money. Now let's walk through a simple example. Imagine you invest $200 per month into a dividend portfolio with an average yield of 4%. If you reinvest all of your dividends and continue adding $200 monthly, over 20 years this could grow to more than $100,000, depending on market performance, while producing thousands of dollars per year in dividends. Keep going for 30 years, and the numbers become life-changing. That's the power of compounding and consistency. But dividend investing isn't just about buying and holding. It's also about monitoring your portfolio. Every quarter, review your company's earnings, payout ratios, dividend announcements, and long-term outlook. You don't need to check every day, but staying informed helps you avoid dividend cuts and poor-performing stocks. You should also watch out for red flags such as declining earnings, rising debt, negative cash flow, and slowing dividend growth. If a company becomes too risky, it may be better to sell it and replace it with something more stable. Now let's talk about taxes for a moment. In the US, many dividends are qualified dividends, which means they're taxed at the lower long-term capital gains rate instead of regular income tax. This can save you a lot of money. If you're investing in a tax-advantaged account like a Roth IRA, your dividends can grow tax-free, which is a massive advantage. Always think about where you hold your investments because taxes can affect your long-term returns more than you think. Next, let's discuss how much you should invest. There is no perfect number. Some beginners start with $50 a month, others with $500. The important thing is that you begin. Start with what you can afford. Build a habit. Grow slowly. Over time, your income will increase, and you can increase your contributions. Remember, every big dividend investor started with their first dollar. If you're watching this video in 2026, here are some example dividend stocks and ETFs that beginners often research. SCHD, VYM, DGRO, HDV, JEPI, CO, PEP, JNJ, PG, SO, O, WMT, MSFT, TXN, and TRO. This is not financial advice, just a starting point for your own research. Always do your own homework before investing. Finally, let's talk mindset. Dividend investing requires patience. You won't get rich overnight. You won't make viral trading gains. You won't double your money in a week. But what you will get is long-term stability, consistent income, predictable compounding, and eventually, financial freedom. That's what dividend investing is all about. It's a slow, steady path to wealth. It rewards discipline and long-term thinking. If you stick with it, your future self will thank you. Before we wrap up, here's your simple step-by-step action plan to start dividend investing in 2026. Open a brokerage account. Choose beginner-friendly dividend stocks or ETFs. Look for yields between 2% and 5%. Focus on companies with strong earnings and growing dividends. Reinvest your dividends. Stay consistent month after month. And most importantly, be patient and let compounding do its work. If you found this video helpful, make sure to subscribe to Stock Predictor for more dividend investing, passive income, and wealth-building content. You're just getting started, and the journey ahead is going to be exciting. Let's build wealth together, one dividend at a time.